Hi, my name is Doc Severson for Ready, Set, Trade, and in this video, I'm going to be talking about the 7 secrets to successfully trading SPACs, or Special Purpose Acquisition Companies. Now, before we get started, let's talk about the purpose for this video. Every so often, there's subtle changes to the investment landscape that ultimately become big opportunities, where it may not seem apparent at the time that there's a big opportunity, but down the road, it's one of those situations where you say, boy, I wish I could have, or I wish I had done something like this. So we can explain this through the product adoption life cycle like this. So right now, the laggards in the investment world are trading things like mutual funds, right? So you're out there doing the Fidelity, Magellan, something like that, and you're getting pretty bad returns from that. Now, late majority are going to be trading things like, well, you can be more conservative trading things like ETFs, and there's nothing wrong with that. Early majority is going to be trading things like stock and options, right? So stock and options out there in the early majority, because now options have crossed over what's called the chasm. So I'm seeing commercials on TV these days for options. So options have transitioned into the majority. So they're becoming much more well known to the average investor. But over here are the early adopters and innovators. So things like this are in crypto. So if you're trading crypto, you're definitely an early adopter or innovator. And under the same area of this is going to be the SPAC right now. The SPAC is in definitely the early adopter phase. Some people are aware of it, but most people treat it like, well, what is that SPAC? I don't want to know about it. Let me stay with my stock or options or ETFs or mutual funds, right? But there's a lot of opportunity if you are an early adopter in SPACs. And I think you'll see the reasons for this through today's video. So let's start by defining what the problem is. Obviously, there is a problem. Otherwise, we'd be all happy with what we're trading today. Well, there is a problem for the retail investor. And the problem starts with the fact that we're in an asset bubble. We have extremely low rates. And because of the fact that we have extremely low interest rates, all of this capital is trying to find yield. And the only place it's going to find yield is in the stock market these days. And this is a lot of the fact due to Fed policy over the last 10 years. That we've been printing money like crazy and trying to drive these rates down to stimulate growth in the stock market. Well, that's happened, but it hasn't necessarily found its way to Main Street. So as a result of this, and these are the prices when I'm recording this, but basically these stocks are expensive. $1,200 for Amazon or an auto parts company, $3,300 a share for Amazon, $640 a share for Charter, which is just an internet company. So it's tough to establish much of a position when each share is running hundreds or even thousands a piece. I mean, you need $120,000 to be able to get 100 shares of AutoZone. That's a lot of money, and most people don't have that laying around, nor could they dump that much into one position. That would not be wise. So is the IPO to the rescue? A lot of people have viewed IPOs, or initial public offerings, as kind of a way around this, because you're getting involved with the stock at the very beginning of its life cycle instead of after it's had a chance to be inflated over time. Well, perhaps, but the problem here is that IPOs are not necessarily cheap either. And for reasons that we'll go into in a minute, it doesn't really favor the retail investor. We're getting in at the end of the parade. So who benefits from the IPOs? Well, it may make some sense to walk through how IPOs are done so you can see where you fit in on the cycle as a retail investor. So private companies go public because they're trying to raise capital. They're trying to go public through an IPO, and that capital can be used to fund research and development, plan capital expenditures, or pay off existing debt, or maybe even just give yourself a convenient exit strategy for this. But do you see anything in this list about the retail investor? No, it's not done for your benefit. Some of the steps to list is, and we're just going to go through these quickly, find an investment bank partner. So the investment bank partner takes on the risk and pretty much runs the whole relationship. So some of the standard things are to go through all the due diligence and paperwork of this, including filing the red herring prospectus, which lets people know what it is that you're doing and generates investor interest, and that culminates through the roadshow that you give. So this is where you get to meet and greet and sell your idea to some of these funds and try to generate some interest, and maybe, just maybe, that investor interest will come in the form of some institutional funds, which is exactly what you're looking for. And those institutional funds are not going to want to get in at the public's price. They're going to want to get in at a preferential price. So you're signing a deal with the devil in some cases, that you're going to take their capital, but at a much lower cost. And this is typically what happens on the roadshow. So then finally you go public, and this is the date that the shares actually become public and available to investors. Typically 75% of the shares are retained by the owners, and 25% of the shares are for sale. But here's the thing. Of that 25% that are for sale, typically 85% of that bunch are sold to institutions way before the actual public date, and typically at less than launch prices. So what does this mean to you, the investor or the retail investor? Well, what you're doing is you're fighting over that 15% of the 25% of shares are for sale, which means there's only 3.75% of the total shares available for sale on the IPO date. So very little float. It ends up getting bid way up, typically trying to hit that date, and you're getting in at a lousy price. And typically this is the very high watermark for an early day IPO, is that everybody's getting on board from the retail space at the very highest price, and typically it drops down from there. Go through any stock that has recently gone through an IPO, and you'll see the IPO date generally shows the high watermark. So what does this mean to retail? It's fundamentally disadvantageous to the retail investor. The bottom line here is that it pays to be an insider, and take the early risk. I have no problem with that. All of those insiders, those corporate insiders, are taking the risk. They're the ones that should be paid. That's fine. And it also pays to be the investment bank that brokers the deal, gets a healthy commission that doesn't have anything to do with providing the product or service. It also pays to be an institutional fund that gets preferred access to those shares. Being a retail investor means you're end of the parade. You've got your bucket and shovel, and you're cleaning up after everybody else. So it doesn't sound too good, does it? Doesn't sound like a very good deal. Well, this is where SPACs come in for the retail investor. So what is a SPAC? Well, SPAC stands for Special Purpose Acquisition Company, which is a publicly traded issue. It actually trades on the stock market. It's a blank check company raising capital to acquire somebody. So they don't have any earnings or anything yet. It's basically a company looking to acquire someone. So this is the IPO 2.0. It's a blank check company that's formed for the express purpose of acquiring a private company to take public. The money that SPACs raise in an IPO is placed in an interest-bearing trust account. These funds can't be used by anything or anyone except to complete an acquisition or to return the money to investors if the SPAC is liquidated. So in practice, these companies will typically have a $10 price floor on the actual stock. The advantages of SPACs, especially for retail traders, is that it allows you to get on board with a blank check company at any point during the process. You can either get really early, the process of finding a target company before they're even announce who they want to acquire, or once they do announce who they want to acquire, the due diligence filing period with the target company. So that is public. Everybody knows who they want to acquire. And eventually you can get involved in the eventual public offering of the target company. This will become a little bit more apparent as we go through some of the examples. So the issue here is that versus the IPO, the standard IPO where you're at the end of the parade, you can pick whatever part that you want of this as early as possible in the formation of the SPAC. More risk, but more reward. Let's talk about the risk for a second. If you're an early investor in the blank check company, there's no guarantees that the acquisition will even be completed. There's no guarantee that the target company is truly worth consideration. Fortunately, there is a floor price for the stock shares that are created for SPACs, but not the derivatives that we'll talk about. So what a SPAC represents is, to the retail investor, a much earlier entry point to invest in the company, less interference from the SEC to try to protect you. Oh, you're not a qualified investor, so we're going to protect you. We're not going to let you get in until much later. Okay, so there's more potential reward, but possibly more risk as well, too. It's a more immature investment, so it requires you to be a little bit more sophisticated and puts the burden of proof on you, the retail investor. So when it comes to trading SPACs, there's 4 different ways that we can do this. When the blank check company SPAC goes public, the SPAC offers units, which are generally 1 share of common stock and 1 or a portion of a warrant. This is for the early birds. This is typically not done by most retail investors. The stock is common stock, just like what you're used to trading. This $10 price floor generally stands. Most SPACs you see trade above that $10 mark. Warrants are interesting. They're like a call option, but traded like a stock. So you can buy 1 warrant equals a warrant on 1 share of stock, unlike options, which are relating 1 option to controlling 100 shares of the stock. So most SPACs have at least a monthly option chain. Some of the more active SPACs do have weekly options as well. So these are generally the 3 different types of trading instruments that we're going to be using: the stock, warrants, and options, of which we'll talk about in a minute. So how do you get started with trading SPACs? Well, let's get started with the 7 secrets to SPACs, and I think by the end of this, you'll have a good understanding of how to get started and what you can do. All right, let's get to secret number 1. And that's to study the previous SPAC winners. One of which is Nikola Motors. Nikola Motors started as VTIQ. This was the SPAC stock ticker, VTIQ. So you can see back here is where nobody knew what VTIQ was going to acquire. And at this point they say, you know what, we're going to acquire an electric vehicle company. And so this started the speculation for that. And then as it became clear that the merger was going to take place, this is where things started to really take off. And at this date over here, this is where it became Nikola Motors. So the SPAC eventually became the IPO for Nikola Motors. So again, this is the early phase that you can involve yourself into. This is the SPAC. Whereas most people are just going to understand Nikola Motors and are going to enter at this price over here. And as you can see, this is just like the old retail problem where you're getting in at the highs. Those that understood the SPAC were able to get in much earlier than this and perhaps sell out before all the retail destruction occurred. That's Nikola. DraftKings is another famous one, and this started off as DQ, DEACU was the actual SPAC stock, and then that's transferred into DraftKings in April of 2020. And then since that point, since that IPO level at DraftKings, it's done quite well as a stock all on its own. So in this case, getting into DQ early gave you much more of an advantage than trying to chase after this thing down the road as the IPO. Virgin Galactic also was IPOA as the SPAC, and this was way back here at, $11 a share when they became an IPO, and then this eventually did take off to the upside as SPCE. This is the IPO stock for Virgin Galactic in October 2019. You can see what it's done since that point. Plenty of opportunity to the upside and to the downside. But getting involved in the SPAC gave you much earlier access way back here in 2017, 2018, before it became anything at all. This is before the merger was even announced with Virgin Galactic, and this is where it started to take off. So conclusions here: buy the rumor, sell the news is how they move. They're very news flow generated. This is not typically a buy and hold type of thing unless you want to play it in that type of manner, right? So there's huge realized volatility during SPAC's life. Growing a company into a sustainable business is tough work. It takes a lot of time. This is not something that occurs typically within just a few months. So think about to yourself, is this more of an opportunity to invest or to trade? Buying a SPAC is no guarantee. It's no silver bullet just because you get into it early, but perhaps you can capture a portion of that value very, very early on and then move on to something else. The very best entries will always be those that seem to feel the worst. Never, never chase after something. So that is secret number one, is to study the existing SPAC winners. Secret number two is sizzle and sector. This is not the time to pick safe when it comes to SPACs. If you want something that moves, it's got to have sizzle. It's got to be in the right sector. What do I mean by those? Well, you can find the most disruptive accounting firm going public through the SPAC process with solid fundamentals, mature management team, but it's just not going to move. Nobody cares about a great accounting firm. You've got to find candidates that meme and candidates that have that sizzle. You want candidates that people will talk about and get on the front page of the newspapers and of the web pages that talk about the financial market space, right? And encourages speculative investing from an institutional basis, as well as retail too. So think about some of the hot sectors that are out there today. As I'm recording this, one of the hottest sectors out there is obviously electric vehicles driven through Tesla. So this is what's hot, but it may not be hot 6 months from now. There may be another sector that's going bonkers by that time. So sizzle and sector is something that's very, very important for your SPAC. Now we get to secret number three, which is determine your approach. It's important to define your trading approach before you enter. You don't want to just enter and say, well, I'll figure it out as I go along. We know how that works, right? So understand how SPACs move, first of all. Once a SPAC is formed and publicly traded, it might not move much at all until a rumor hits the wire about the potential company to be acquired. You can see down here in Nikola, when this used to be VTIQ, it didn't move at all. So you were owning VTIQ and it wasn't moving at all. And you're thinking to yourself, well, this is a waste of opportunity and capital. Nothing's going on here. But if it eventually hits number two here, if the acquired company, hey, we're going to buy an electric pickup truck EV company. Whoa, that's got some sizzle to it. It's the right hot sector. Then the SPAC, stock and warrants will start to take off. And this is phase two over here. And then there's going to be a cooling off period before the actual merger occurs. During this time, the price of the SPAC will definitely come under pressure. But then once the merger starts to become obvious, this is where I would say this is the end of number three. Right before the acquisition, it'll start to take off again. And then once the merger occurs, this is the merger, and this is where the IPO, there could be a huge amount of public attention at this phase. And number four, this is generally the phase you might want to consider selling into, because now it's just a stock on its own. It's no longer a SPAC. It is now an IPO right there. And this is where, again, retail usually buys in at the high, and the whole 3.75% deal is happening. But back here in phase 1, 2, and 3, that's not the case. You're not fighting for 3.75% of the stock. So that's how SPACs move. So you can take a conservative approach to this. You can say, well, I just want to be a value investor. I want to buy the dips. I want to acquire as much as I can. And I'm generally going to have a very long time frame for this because maybe I think that this company's not going to be anywhere for the next 5 to 10 years because they've got a great idea, but it's going to take them 5 to 10 years to build an assembly line and distribution system for this electric vehicle. Okay, so you can take a very long-term value approach, look to buy the dips for this, accumulate, and there's nothing wrong with that, right? But just keep in mind that it's going to take a while for these to pay off. Or you can take the aggressive approach with this and sell into strength, just trade, right? So acquire low, sell into strength, acquire low, sell into strength, keep doing it again. Or maybe even short this thing as it gets parabolic. There's a lot of different ways you can play these. That's the aggressive approach, but you have to ask yourself, what is your edge? What is your competitive edge? You're trading against the herd after all. So any competitive edge that you have to have is going to be basically taking the other side from the low information investor. Trend trading and time decay are two standard edges that you can use to be on the other side of the panicked herd. And that's surely the strongest edge of all, to be on the other side of those guys. So you've got to find your way. The quickest path to failure is to try to emulate somebody else. So most traders just kind of bounce around from one thing to another, to another, to another, and they never really find their way. So define your approach. Don't be chasing after these things. And be proactive about defining your approach to trading a SPAC. Ideally, your approach should mirror your own belief system and principles. Don't try to be somebody else. And then we get to number 4. And this is to find the North Star. So for every SPAC, especially after they announce their intended target company, there's going to be a North Star to them. That North Star is going to be the leading stock in that particular sector. It's going to be lighting the path for that sector and everyone that follows in it. So for example, as we look at some of the electric vehicle SPACs, obviously Tesla is the North Star to the EV market. Every SPAC is aligned to electric vehicles or transportation as a service will rise or fall with a North Star, which in this case is Tesla. So if we look at Tesla versus SPAQ, which was Spartan Energy Acquisitions, so that is still a SPAC that's out there. Generally, Tesla and SPAC run together. Not all the time, but generally they run together for Fisker. And then we have Tortoise Shell, which became Hyliion. Tesla generally was running with Tortoise, or I should say Tortoise was running with Tesla, and eventually became Hyliion. And then we have Tesla versus DPHC. And this is Lordstown Motors, and Lordstown Motors generally runs with Tesla. So the electric vehicle market is using Tesla as the North Star, and generally a lot of those SPACs, not having any fundamentals or numbers or anything other than speculation, will generally run with them as their North Star. So keep that in mind for every SPAC that you have. Find the North Star for that particular sector. And now we get to secret number 5, which is trading stocks. We can just trade the SPAC stock. And we're just going to use the standard methods that we use for everything else and set our risk to 2% for that specific trade, no more. So don't put your whole account into a SPAC. Bad idea. Limit risk on any one trade to 2% of your capital. In this case, we can look at breakouts. We can use different systems like trend trading, using the Jontian channels in this case for trend trading breakouts, making sure that we risk no more than 2% on every position for these. Buy these with a trailing stop, run them as far as you can. Or we can also take pullbacks. In this case, we can use something like the RSI in Laguerre time as an oscillator to identify, in this case, long hooks out of the oversold zone as the entry point for, in this case, Tortoise or Velodyne are a couple examples of this. So this is our study that we use in Elite called the RSI Laguerre with Embedded Fractal Energy Study. So in this way, trade these, don't hold these. So you can try to run them as long as you possibly can, which is great if you can do it, but they're so volatile that it's sometimes better just to sell into strength on these types of movements. So if you're going to use these types of movements, if you're going to just trade the stock, trade them and not necessarily hold them unless you're going to run with a very, very conservative approach. So a trade example here, and this is not necessarily a great one because I held this one for way too long. I got in at a nice entry point down here and watched this thing and just sort of got complacent as the price got up to there. And I was thinking that, wow, it's probably going to retest the highs again. Well, it didn't. And I had to suffer through this pullback, which almost brought it back down to break even for the position again. And I decided, well, okay, let's learn from that. Let's sell into strength here. And that was good for a 19.5% return, but I could have done much, much better had I taken my own advice. And this is part of the learning process. You have to learn how they move, sell into strength, sell them, become a trader, right? So trade these moves. And unless you're going to run with a very conservative approach and go for a long term, 5 to 10 year dropping your cost basis. So trade the SPAC stock. That is number 5. Number 6 is actually to trade the warrants. The warrants versus stocks. The warrants trade at a discount to the stock. So it's going to be a cheaper way to get on board and offers you leverage. And you can actually chart the warrant versus the underlying SPAC itself. And you can see that they roughly run together. It's a derivative. The warrant is a derivative of the stock price. The warrant can go to zero if no target company is acquired within the 5 years, which they should. Okay. An example of leverage here, if we took Pershing Square stock went from 2160 to 2330. So during that time, that's a $1.70 gain or 7.9% return on capital. Okay, that's nice. Nothing to write home about. But if we did the warrant here, it went from 580 to 870. That's a 290 gain or a 50% return on capital. Which one sounds better? Understand that the knife cuts both ways, right? Also can work to the downside in the same way. But warrants give you, especially a smaller investor, a lot more leverage to work with versus the stock. So trading warrants, here's an example of a warrant trade. They trade just like stock. This is an example of TD Ameritrade. You can see that it offers, there's a bid and an ask on here, just like a stock. And I can either trade 100 or I can trade one warrant. And one warrant in this case would be $7.15. Or I can buy 100 warrants, and that's going to cost me $715. So it's just like buying a stock. Here's an example trade of this. And this position is still live as of this recording. But I bought these warrants at the end of September in 2020 for about $7.03. And a couple weeks later, the price had gone up to $7.79, 76% gain, 10% return on capital versus the stock, which was a 2.8% return on capital. So that position is still live. It had not been, as of this recording, had not been consummated yet. So this is still a live position, but you can see the difference in leverage for the warrants. So warrants are a good example for a different type of instrument that you could trade with leverage. And it's particularly good for a small account to keep that 2% risk on the position. So that is trading warrants. And that leads us to number 7, which is trading the options. So some SPACs, I would say most of them, offer standard monthly options. Some of them offer weekly options. And these are going to be the standard puts and calls. Now, you can trade these directionally, puts and calls. They can be used as directional proxy for the underlying stock, but only for the specified time to expiration. This, I believe, is a very poor way to use options. It's the one that's the simplest to understand, but quite honestly, this is the very most difficult way to make money on an option, is to buy long calls or long puts. High leverage, because you're buying. In this case, you could see like buying this call option here, you're going to be spending somewhere around $2.40 or $240 for one contract to leverage 100 shares of the underlying stock. And this has only got 16 days left to live. And if the price does not go higher, if it goes sideways or down, then you're going to kiss all of that goodbye. So it's a relatively high risk, high reward type of trade with a low probability of success. So I would say avoid complex option strategies. So if you have a little bit more experience, you may have experience with like iron condors and diagonals and calendar spreads and iron butterflies, things like that. I just don't think the strike price granularity as well as the liquidity of these options really supports some of the more complex options. Now, some of these SPACs may eventually get to be very popular and attract a lot of investment capital, and maybe that'll be the case. You can use complex options, but I would say keep it simple for now. And when I say keep it simple, I would say trade the wheel of fortune. This is where we're going to be selling cash secured puts. So sell puts below the current price, sell puts at a level that you'd be a willing buyer. A short put obligates you to buy the stock if the price is at your strike price or below that at expiration. If the price of the stock is above your strike price, then you keep that credit and your option expires, your obligation is released. So basically you're getting paid to buy the stock at a pullback, which is a great strategy, as long as you can maintain your risk on this. So if you do get assigned, then you can turn right around and sell covered calls against it. It's kind of like renting out your stock until at some point you get called out, you go back to cash, and then you can go sell puts again. This is the wheel of fortune. So an example of this would be, in this case, for like SPAQ, you could sell puts the 20 November for 12.5. You're going to be paid somewhere around $210 a contract, which is a 16.8% return on capital. You're only going to be assigned should the stock be at or below $12.50 by the 20th of November. That is a short put. Here's some other trade examples using options. Here is FVAC. Here's a trade that we entered on the 28th of September, or excuse me, this is the trade that we entered on the 28th of August, closed out on the 28th of September for a month. So we earned $750 on this trade. We used $12,500 of capital. We made 6% on our money, doing absolutely nothing for a whole month. So this is the definition of passive income. Here is Workhorse. We did the same kind of thing here. We entered in the middle of September, and 2 weeks later, we closed out the position. We earned $500 from using $8,000 of capital. That's a 6.25% return on capital. We did absolutely nothing for 2 weeks. We sold into strength. We closed the position into strength. Here's another example. This is a live trade. We sold Pershing Square at the end of September. We sold short these puts. $625 credit. We used $11,250 of capital. That trade is still open as of this recording, but this is what we do. We don't have to do anything to earn this money. We just have to sit and let the time value decay in the position. And if it does drop, in this case, the strike price is $22.50. If the price does drop to $22.50 at or below that level by the 20th of November, then we'd be obligated to buy 100 shares per contract of that. So those are some examples of option trades that we've done on some of these SPACs or some of the stocks that have come from SPACs. So secret number 7 is to trade the options and use simple methods with those. Okay, so we've gone through all 7 of these secrets. None of these are really, should be really a surprise to you if you've been trading for any length of time. It's a very organized approach to getting on board with SPACs so you can see what a SPAC is, what the advantages are to the retail investor, what the risks are as well. So let's summarize this presentation here. So where do you go from here? Success is a progression. To be a successful trader, you have to create a plan that works for you. You can't just copy somebody else's and expect success. You have to do something that you've internalized and makes sense in your own mind. So study those previous SPACs. Which ones are hot today? Which ones do you think are going to be hot tomorrow? Understand today's sizzle and hot sectors for SPACs. Define what your approach is. Are you more conservative? Are you an investor? Or are you more aggressive? Are you more of a trader? Identify the North Star for the sector of the SPACs that you're interested in. Determine what your stock trading plan is if you're going to trade stock, or understand what the benefits and risks are behind warrants. It's a very interesting and different way to trade these. Or if you're a little bit more experienced and if you've traded options before, or you have the permission to trade options, this is always a good approach. And figure out what your option trading plan is for SPACs. So some of you, that's enough. You've got enough to run with and you're all set to go. Maybe you've got a little bit more experience. Others of you are fairly new to investing. You might be wondering how you can get started on your own path through these steps. It's great to feel motivated, but without a map to get there, you may have difficulty. So consider joining our community here at Ready, Set, Trade if you want to know more about how to trade SPACs or understand how to build a trading plan or get over some of those problems that have been limiting you as an investor. We're a community of traders who seek high probability, low risk trades in the options and futures markets. Typically, we're seeking to earn $100 a day through a lot of different passive income trades, as well as some active income trades that we take intraday. So we provide the structure and guidance to show how to quickly come up to speed on many topics such as these high probability trading strategies, or how to find and qualify and trade SPACs. We actually have what's called a SPAC tracker list with all the latest candidates that are coming up in the SPAC world, plus all those other intangibles that are necessary for success, which is that community where you can go to and say, hey, I got a question here. Think about this for a second, and then I'll let you go. Goals are for people who care about winning once. It's easy to get a goal, but systems are for people who care about winning repeatedly. Think about getting yourself a system, and maybe your system is joining our community. Thanks for watching this video. I hope you got a lot out of it, and welcome to our community.